You see a stock price rocketing higher on a chart, and your first instinct is to jump in, to chase that momentum before you miss out. But what if I told you that the price move alone is only half the story, and sometimes it's a complete lie designed to trap eager buyers? The truth is, price tells you what is happening, but volume tells you how much conviction is behind the move. It's the difference between a genuine, powerful trend and a weak, unsustainable pump that's about to collapse. Learning to read volume in conjunction with price is arguably the most important skill you can develop as a technical trader. It's the ultimate confirmation tool. The lie detector for the market. In this video, we're going to demystify this critical relationship. We'll break down exactly what you're looking at when you see that volume bar at the bottom of your chart, and we'll explore the powerful signals that occur when volume and price work in harmony. Or more importantly, when they start to disagree. Let's start with the absolute basics. What exactly is volume? On any stock chart, you'll see a series of vertical bars at the bottom, typically corresponding to each candlestick or bar on the price chart. Each volume bar represents the total number of shares that were traded during that specific period. A tall volume bar means a high number of shares changed hands, indicating a lot of interest and activity. A short volume bar means low activity and a lack of interest. But the raw number isn't as important as the context. This is where the concept of relative volume comes in. Most trading platforms will show you if the current volume is above or below the average volume for that stock over a specific period, like the past 20 or 50 days. A stock trading at 200% of its average daily volume is experiencing something significant, while one trading at 50% of its average volume is in a quiet, sleepy state. High relative volume gives weight and importance to the price action happening at that moment. Now, let's connect volume to price movement, starting with the most fundamental principle in volume analysis. In a healthy trend, volume should confirm the direction of the price. What does that mean in practice? In a strong uptrend, you want to see volume expand on the up days, when the price is making new highs or pushing strongly upward. This shows that buyers are enthusiastic and aggressively accumulating shares. Conversely, you want to see volume contract on the down days, the minor pullbacks within the uptrend. This shows a lack of conviction from the sellers. There's no rush to get out. This combination of high volume up days and low volume down days is the hallmark of a powerful, sustainable bull trend. It's a process called accumulation, where smart money is steadily buying up shares. The exact opposite is true for a downtrend. A healthy, scary downtrend will have high, expanding volume on the sharp down days, showing panic and aggressive selling, and lower volume on the feeble bounce attempts, showing a lack of serious buying interest. This is distribution. One of the most critical moments to watch volume is during a breakout. A breakout occurs when a stock's price moves beyond a key level of resistance, suggesting the start of a new uptrend, but not all breakouts are created equal. A high-volume breakout is a thing of beauty, when the price punches through resistance on volume. That is 150%, 200%, or even higher than its average. It's an incredibly strong signal. It tells you that institutions and large traders are piling in, providing the massive fuel needed to sustain the move. This is a breakout you can trust. On the other hand, a low-volume breakout is a major red flag, often called a fakeout. If the price barely squeaks above resistance on weak, below average volume, it suggests a lack of conviction. There are no big buyers behind the move. It is often just a trick that traps retail traders before the price reverses sharply and slams back down below the resistance level. The same logic applies to breakdowns below support. A high-volume breakdown is devastatingly bearish, while a low-volume breakdown might be a false alarm. Perhaps the most powerful volume-based signal is when volume and price diverge. This is when they stop agreeing with each other, and it often foreshadows a major trend reversal. The most common example is a bearish divergence in an uptrend. This happens when the stock price makes a new high, but the volume on that new high is significantly lower than the volume was on the previous high. This is a massive warning sign. It means the price is moving higher, but the buying pressure is waning. The rally is running out of fuel. It's like a rocket slowing down even as it appears to be climbing. It's only a matter of time before gravity takes over. The opposite, a bullish divergence in a downtrend, occurs when the price makes a new low, but the volume on that sell-off is lower than the volume on the prior low. This suggests that selling pressure is drying up. The sellers are exhausted, and even though the price is falling, the force behind the decline is weakening, often setting the stage for a reversal to the upside. These divergence signals are not timing tools for immediate entry, but they are powerful alerts that the trend's health is deteriorating. To put it all together, think of yourself as a detective. The price movement shows you the crime scene, but the volume is the evidence that tells you who committed the crime and how it happened. Is there genuine conviction behind this move, or is it just market noise? Before you enter any trade, make it a non-negotiable rule to glance down at the volume. Ask yourself, is volume confirming this price action? Is this breakout happening on high volume? Is this pullback happening on low volume? By making volume analysis a core part of your chart reading process, you will filter out low probability trades and significantly increase your chances of catching the big, sustainable moves. Remember, this is educational content and not financial advice. Trading carries a high level of risk and you can lose more than your initial deposit. It might not be suitable for all investors. Please ensure you fully understand the risks involved and seek independent advice if necessary. If this breakdown of volume and price has given you a new lens through which to view the markets, please support the channel by liking this video and subscribing for more trading insights. Now, I'd love to hear from you. Have you ever been caught in a fake-out breakout that volume analysis could have helped you avoid? Share your experience in the comments below.